Good afternoon, everyone. Welcome everyone to this clinic session that's going to cover disaster risk financing for microfinance, hosted by ACliFF, the Asia Pacific Climate Finance Fund. My name is Josh Ling. I'm a climate change specialist at Asian Development Bank and the fund manager of ACliFF. In this session today, we will aim to share and generate ideas on how disaster microfinance products and solutions can build the resilience of the urban poor. We will cover the types of innovative solutions that are available, discuss how these can be supported and funded, and give special consideration to how these solutions can be designed in a way that is gender sensitive and ensuring equal access to women. A few points of housekeeping as we get started. You'll see on the right side of the screen, there's a Q&A box, a chat box, a feedback tab, and a poll question tab. Throughout the session, please feel free to ask questions in the Q&A box, or for the questions that are already there, simply press like on the ones posted by others. Those that have the most likes will appear higher in the list, and we will have a session for Q&A towards the end of the session today. You can also use the chat box to share comments and insights. On the left side of the screen, if you have a look, there's the activity feed where quote cards and insights will be posted. And I also wanted to advise everyone that this session is being recorded. To move into the presentations, I wanted to open the session today by giving some framing as to why this topic is of particular interest to ACliFF. So ACliFF, the Asia Pacific Climate Finance Fund, is a dedicated fund for supporting the development and implementation of financial risk management products to unlock investment into climate change mitigation, adaptation, and disaster risk management. When we're looking at disaster risk financing solutions, we're talking about financial risk management products that can support the microfinance sector in its role to provide resilience to the urban poor, and in a way that is inclusive of women and the most vulnerable. We have a brief video that can explain and give an overview of the fund, and I'll ask to bring that up now. Thank you. We don't seem to have audio.
Have an urgent need to invest. Asia and the Pacific is responsible for around 50% of global greenhouse gas emissions, and the overall level of emissions continues to grow. The region also experiences devastating extreme weather events, and climate change is making these increasingly frequent and more severe. Developing countries have an urgent need to invest in climate change mitigation and adaptation. To limit global warming to below the 2-degree target, estimates suggest an annual investment of at least $200 billion in climate-related infrastructure is needed across the region, increasing even higher beyond 2030. Current levels of climate investment fall well short of these levels. The Asia Pacific Climate Finance Fund, ACliFF, aims to unlock capital for climate investments and improve resilience to the impact of climate change through the innovative use of financial risk management products. Through ADB and non-ADB projects, these financial risk management products support ADB's developing member countries to scale up the adoption of climate technologies. For example, guaranteeing the performance of new renewable energy solutions could accelerate their take-up by providing assurances to new users. Mobilize new sources of private sector climate financing. Credit, liquidity, or other market risks may limit private sector investment in climate projects. The smart use of financial risk management products can scale up climate investment through blended finance solutions. Support investment into climate-sensitive sectors. Sectors such as agriculture, water, fisheries, and others are highly exposed to climate risks Yet, more than 60% of the people in Asia and the Pacific work in sectors highly susceptible to changing weather patterns, including some of the region's most vulnerable populations. Using financial risk management products to manage this exposure can increase investments into these sectors and foster their growth. Address extreme weather events. Products such as insurance can help improve the resilience of vulnerable and low-income populations by enhancing their financial preparedness for extreme weather events, in turn supporting more rapid recovery. ACliFF's credit enhancement products are supporting the structuring of renewable energy projects in Uzbekistan and the Pacific Islands. The fund is exploring how financial risk management products can incentivize green lending in Kazakhstan. ACliFF is providing seed grants to startups working on innovative technology-related climate solutions across Asia and the Pacific. ACliFF is also supporting the development and rollout of disaster insurance solutions for city governments in the Philippines, as well as for micro, small, and medium enterprises through the V20's Sustainable Insurance Facility. ACliFF is a multi-donor trust fund administered by ADB, established with financial support from the government of Germany's BMZ. ACliFF supports the achievement of the targets of the Paris Climate Agreement and complements other international initiatives, such as the INSU Resilience Global Partnership and its Vision 2025 target to cover 500 million poor and vulnerable individuals against climate and disaster shocks by 2025. ACliFF also supports the V20's Sustainable Insurance Facility and the development of climate and disaster risk insurance solutions in V20 economies of the region. To find out more, get in touch with the ACliFF Fund Management Team and learn about how ACliFF is supporting ADB to achieve a prosperous, inclusive, resilient, and sustainable Asia and the Pacific.
So as you can see from the video, there's a number of different ways that financial risk management products are being used to unlock investment and to scale up climate action for climate change mitigation, adaptation, and disaster risk management. And as I mentioned, this session will look specifically at how we can support the microfinance sector in its role to provide resilience to the urban poor and in a way that's inclusive of women and the most vulnerable. We have two keynote presentations today, and before we move to those, I will run a quick poll question. I will ask you to click the poll tab at the right side of the screen and answer the following question. It's estimated that how many times are women and children more likely to die from disasters than men? Is it A, 5 times, B, 9 times, C, 14 times, or D, 20 times? So this is a statistic that I took from a report applying a gender lens to climate risk finance and insurance of the Insure Resilience Global Partnership. And Catherine, one of our speakers today, was a co-author of this paper. So I'll give a few minutes for results to come in. See a few more results coming in. Maybe we're getting the final ones now. So interesting. I mean, any of the answers really show that women and children are significantly more likely to die from disasters than men. The correct answer in this instance is actually 14 times. So perhaps there are a couple of you that got that right. But yes, this statistic is just one of many that show that these solutions really do need to analyze and design for the specific needs of women and children. And we're going to hear about that a little more a bit later in the session today. As we move to the keynote presentations, the first presentation is on disaster risk financing for microfinance. I'll introduce our speaker, which is Jerry Skis. Jerry is the Executive Director of Global Parametrics and also the primary founder and visionary behind Global Parametrics. Jerry has worked on several projects that focused on protecting microfinance from natural hazards. And these include the development of the globally acclaimed index-based livestock insurance program in Mongolia, core research in Ethiopia that led to the Africa Risk Capacity Facility, and the development of the world's first regulated insurance product in Peru, paying before a disaster, coined forecast insurance, and laying the foundation for ongoing global efforts in forecast-based financing. Financing the business interruption created by natural hazards is at the core of Jerry's ongoing contribution to Global Parametrics, and that's what we're going to hear from him about today. Unfortunately, Jerry could not be with us. He's on a flight to the UK as we speak, but we have a pre-recorded presentation from earlier this week that we're going to bring up right now. And just a reminder, please continue to post your questions into the Q&A box. But for now, we'll move to the presentation. Thank you.
Yeah, good day. I'm sorry I'm not able to join you today. I should be landing in London about now. I'm Jerry Skis. I'm the founder and executive director for Global Parametrics. I had a company before called Global Ag Risk. We worked on a lot of these issues around the world with disaster risk, and in particular, how to support microfinance and other financial institutions. I think the most important thing for the message in this presentation is the idea that these geophysical hazards, drought, excess rain, flood, heat waves, tropical cyclone, earthquakes, landslides, pandemics, they all create a significant business interruption. And what we're learning about the dynamics of financial institutions is that when you have these kind of business interruptions that are created because people are having trouble throughout the loan portfolio, is the dynamics actually create problems in the future for access to and the cost of capital. And of course, we all understand that if you're trying to do financial services, these two things really impact the growth of any microfinance institution. We're learning a lot more about these risks, and I would argue right away that a lot of this discussion really belongs with the banking regulator. We did some work with the Gates Foundation in Peru some years ago, and we saw it straight out. Here's the progress in agricultural lending. El Nino of 97, 98 came, big disruptions throughout the northern part of Peru, and agricultural lending basically stopped. We estimated that the cost of capital was at least 200 basis points higher because of extreme El Nino and the return period. So we're, again, access and cost of capital. We're understanding this more deeply now. Recent work shows that it's 117 basis points added cost for low-income countries. And that evidence comes from looking back at only climate risk. That means seismic risks and pandemics weren't included in this. And what we've got now is the last 50 years, extreme weather events have been over 5-fold increase. So that's kind of the future we're facing. What does that really mean? Well, it means that we need to build ex-ante disaster financing where we can rebuild the balance sheet of financial institutions when they're slammed by these events. That gives the opportunity for business continuity after the recovery lending and also recovering lending, which can be very important for building resiliency as you build back better. So I'm going to repeat these themes in a couple of different ways. You've got the microfinance institution that has all of these disruptions. They've got the capital erosion, non-performing loans increase, people are withdrawing savings. There's this whole dynamic. But at this very moment, when the community needs the capital, because of this erosion of the balance sheet, the financial institutions least able to respond. I consider that not acceptable. Now, Ben Collier did some work using mixed market data and EMDAT data And basically with this econometric work, he showed that the growth trajectory of microfinance institutions in the first year after the disaster decreased 11%, and it lasted into the second year, another 8 percentage points. Those lenders that had the low capital base to begin with actually couldn't lend. Now, you have that trade-off. You're either going to keep a lot of capital, which is very expensive in order to withstand this, or you're going to use disaster risk financing so that you can rebuild your balance sheet. Those two things are quite important. And that's what we're talking about in the third panel. And what I want you to understand is this is a good opportunity, actually. There's more evidence that when the financial institution is able to make loans immediately after the disaster, there are good things that happen. So again, let's go through the dynamics. The individual client loses their time because they're trying to pay back and they're being put in a position where they can't pay back on the loans. They can't get access to any new credit. They have this reduced standard of living. And ultimately, we've seen a lot of this in the literature, the poor end up selling assets, or they put children to work, or there's migration, lots of dire consequences if they can't get access and rebuild their livelihoods. Now, when you think about what that means for the financial institution, they have slow growth, non-performing loans, they have no new funding capability, and they've just got this weakened balance sheet. So if we can put cash with disastrous financing into the balance sheet, we can facilitate credit recovery lending. This means new loans. You can have the cash, the capital, liquidity to extend the grace periods, restructure loans. You can create a dynamic where you're able to compete, get new clients, and you end up restoring the livelihoods of the poor and vulnerable, your very client that you care about. What does this mean for the financial institution? Well, if you do this in a proper way, you're able to continue your growth trajectory. You're also able to mitigate the non-performing loans. You've got that balance sheet stability, the business continuity. You create a client loyalty, and you have a growing financial institution despite the shock of the geophysical hazard. So again, the business interruption, the business continuity, and then I'm going to break down how you can actually organize the financing, the disaster risk financing, through three mechanisms: your own cash reserves, access to contingent credit, and through risk transfer into the capital markets. So all three are quite important. So by this point, I think we're all on the same page. You've got a balance sheet before the disaster. After the disaster, you have this erosion in equity in the capital base of the financial institution. If you can bring in disaster risk financing to add liquidity and capital, and we do this in two ways. We add the liquidity through the contingent credit. We add the capital through risk transfer. You can rebuild the balance sheet, and you can basically make the financial institution strong enough that you can create that business continuity that's quite fundamental if you're going to protect the livelihoods of the poor. So what are we talking about here? Event-based disaster risk financing that triggers the financing mechanisms based on a statistical rank of that geophysical event. The amounts that you use in terms of the financing and the modalities are basically consistent with the ranking. So in this instance, if you're only having an event that's a 5-year event, you would only maybe use the reserves. If you end up with an event that's a 100-year event, you would be using your reserves, your contingent credit, and your risk transfer. So you bring everything together in that kind of sequence. Unlike a traditional insurance offering, this kind of disaster risk financing includes those different modalities of financing, but it's also event-based triggered on third-party data, and it doesn't require proof of loss, meaning that you've already organized the mechanisms for payment before the disaster ever happens. So what does this mean? It means you get the cash quickly. And it also means that you can extend this. This is not just damage and actual proof of a building going down. This is something that fits into a larger context for that business interruption. Predictive analytics are used to match the hazard and the exposure of the clients. And I'll be getting into more detail on that in just a minute. So this is a parametric disaster risk financing system that we're talking about, using this layered financing. So in this instance, a 5-year event triggers reserves or savings, 7 years contingent credit, and then anything beyond 10-year is the risk transfer mechanism. So you're organizing those financing, and it's fundamental in the sense that this will build the balance sheet back immediately after the event occurs. So we've covered some of these things, but this is just a high-level summary. As you're thinking about these kind of mechanisms, what does it mean? It means that you can retain the clients, and there's a real value proposition in that. You can actually go out and compete against other financial institutions that may not be doing this type of program, and therefore you can acquire new clients. You can reduce your loan write-off systems and keep the system going in terms of the business continuity. And as I alluded to earlier, if you have these mechanisms in place, you may be able to leverage more and have less of a capital base, which of course is the mechanism for financial growth of any financial institution. Now, and again, the last part is immediately after you get the cash from the various modalities and the risk transfer product as well. So these are all the aspects that disaster risk financing allow the financial institution to enjoy. Now you'll notice that nowhere have I been talking about microinsurance. I haven't been talking about the clients buying insurance against disaster, the poor and vulnerable. This can be expensive for them. It can be something that creates a hardship for the poor and vulnerable. You can, in fact, increase the likelihood that they will remain poor if they're withdrawing money consistently to pay for these kind of mechanisms. So the other thing to be emphasized here is that when you're protecting the balance sheet, it is the business itself that should be concerned about that and get the benefits of the growth and all the benefits we just talked about. So therefore, in the best of worlds, I would recommend that you don't pass the cost on to the poor and vulnerable. And I think that's an important insight here. The investors into that financial institution, including development financial institutions, should find value in these added protections. And they should be able to do this because we're reducing the cost of capital and we're increasing the likelihood of continued growth after geophysical shock. So that whole dynamic has an economic proposition. We've put this in practice in a number of different places. In Peru, we had a financial institution that purchased the product that I built with Gates Foundation, and that was done in the northern part of Peru so that they could extend lending. That's the access thing. They knew there was a problem. When they had the El Nino protection, they decided to try to extend lending into areas that were normally quite risky that they had avoided until then. Now, the case for global parametrics, we worked with a microfinance network, Vision Fund International, and today we're protecting 28 countries across the Southern Hemisphere, and we're covering 4 different hazards. And in 2020, we actually showed the mechanism worked, the dual mechanism of the risk transfer and the contingent credit. We had events in the system that protected 675 active borrowers. Importantly, in this microfinance institution, well over 60% of the borrowers are women as well. So what did we do? We actually build something based on the branch location. We weight the portfolio, and we end up with a single contract for a country that will trigger these payments based on the rank again. So we have a natural disaster fund, and we structure that. It's all structured, even with these 28 countries, into a single contract. The Vision Fund pays for itself, and then they implement the recovery lending across their system, depending on the severity, the rank of the disaster. A second case, a microfinance investment vehicle, enabling capital, has protected a Cambodian microfinance institution. Enabling capital paid for this. And they created embedded structures all into a single debt instrument, using subordinated debt to represent the capital that comes from our natural disaster fund, but then using their own systems for contingent lines of credit. So it has quite a few attractive layers of protection for the microfinance institution. That embedded set of options become very attractive in terms of how you actually organize the financing as soon as the disaster occurs. In this instance, it's excess rain in Cambodia and dropped. Now, I have been making a case for a while now that the development financial institutions themselves that invest in microfinance or other financial institutions should take on some of these responsibilities. You can understand why I might make this case, because the development financial institutions are the mechanism for economic growth and poverty reduction. They've increased over 800% from 2000 to 2017. They're well positioned to lead in implementing some of these disaster risk financing strategies. And there is a solid business case, as I argued earlier, for coupling the disaster financing with what happens with the DFI investments into financial institutions. Because if you do this in an efficient way, it increases the long-term growth, lowers the risk, and it increases the value of the financial institutions. They could produce, the development financial institutions could protect their investments at a high level, and then they can crowd in activity from the financial institution itself, acting as an incentive to bring the system together. So I appreciate the opportunity to speak with you. I wished I could be there to answer questions, but certainly I want to thank the sponsors. And as you can tell, I have some passion for this topic. I think it's a very important topic, and I'll be happy to correspond with you in the future if you have questions. Thank you very much.
Great. Well, as I mentioned, we recorded this presentation earlier in the week, and I do have one note of clarification from Jerry. So on those final slides, Jerry meant to say that enabling capital co-financed the solution alongside the Cambodia MFI, as there were several elements to this rather complex transaction. But nonetheless, there are a number of interesting points, I think, to take away from that presentation. It covered a lot of different areas. So maybe touching on a couple. He mentioned many times rebuilding the balance sheet. And so what exactly does that mean? And so I would say that if you imagine a microfinance institution, it has assets and liabilities representing the balance sheet, but also representing what those loan products and savings products that it offers. So when there's a large climate event, this can affect both sides of the balance sheet. Clients need support in this particular moment, and they'll withdraw their savings and have increasing difficulty making repayments on their loans. So that's why we're talking about both sides of the balance sheet and how solutions can really support both sides to rebuild the balance sheet, as he says. And it's also an indication of why a solution needs to have various features. He also made an interesting point that whilst this is happening to the MFI, clients are also in their greatest moment of need. They've been affected by the same climate event, but it's also when the MFI is least able to respond. So in terms of a solution, this creates a really interesting opportunity. A resilient microfinance institution will be better placed to support the resilience of its clients. And so if it's supporting its clients in their moment of greatest need, that's the best opportunity to build client loyalty, or perhaps even to attract new clients who need funding in that moment to help rebuild back after a climate event. I noticed we have one question that's appeared in the chat, and although Jerry's not here, please do post them and I'll do my best to answer them. So the question is, can risk transfer insurance be provided by government and partners to build the resilience of the families, especially on rebuilding in future disasters? I think there's a couple of ways to answer this. The risk transfer or insurance can be provided or purchased by a number of different partners. And I think Jerry was alluding to that a little bit. There's a number of different ways to structure it. Microinsurance is typically an insurance product that's purchased by, let's say, clients of the microfinance institution, but a number of the solutions that he was mentioning were purchased by the microfinance institutions themselves. There's other examples of government entities purchasing insurance, but also that we shouldn't just think of insurance, that there's other types of tools that can be used in this instance. So when Jerry talked about what kind of tools are available to create this holistic solution, we heard the term ex-ante disaster risk financing. So ex-ante, because all of this is put in place before the event. It's in terms of preparing, knowing that funding will come online in the event of a disaster. If the MFI knows that they can count on this funding being available, they can already start to plan exactly how they would use those funds in the event of a disaster. So they're better prepared. And then risk financing, because we're talking about different types of financing tools to manage this risk. So Jerry mentioned holding and using cash reserves as an example for more frequent events, contingent credit for events that perhaps are slightly more frequent, and risk transfer, which refers to products like insurance for the infrequent but very severe events. So ACliFF as a fund is supporting the design and implementation of financial risk management products, and it's this type of solution that we're looking at in the instance of microfinance. So by better supporting the financial risk management of microfinance institutions, you can see in this particular example, there's a number of flow-on effects and flow-on solutions that also increase the disaster resilience of the low-income individuals that rely on that microfinance institution. And Jerry is supporting ACliFF to look into the ways that the fund can support these types of solutions. Beyond this, the eligibility criteria of ACliFF also calls out an emphasis on targeting low-income vulnerable populations and on including gender considerations into the design of the solutions that it supports. So I'd like to move to our next keynote presentation, which is around gender-sensitive design. We will cover gender-sensitive design in how to put together these disaster risk financing solutions. So allow me to introduce Catherine Miles, who's a gender consultant to the Ensure Resilience Gender Working Group and technical expert on the gender dimensions of climate and disaster risk finance and insurance. Catherine co-authored research and guidance, including integrating gender considerations into different models of climate risk insurance and applying a gender lens to climate risk finance and insurance on behalf of the Ensure Resilience Global Partnership. For nearly 2 decades, she has been working internationally at the intersection of multiple thematic gender agendas related to sustainable development and specifically women's access to insurance and financial inclusion. I'm very happy that we have Catherine with us today, and I'll hand the microphone over to her now. Thanks, Catherine.
Thank you, Josh. Thank you. So in this presentation today, I've been asked to briefly highlight how women and children are disproportionately affected by climate disasters and the opportunity that disaster microfinance solutions have to be designed to ensure that these needs are met. Just really briefly, first of all, I'm just going to explain a little bit about Insure Resilience. The Insure Resilience Global Partnership for Climate and Disaster Risk Finance and Insurance Solutions is aiming to strengthen the resilience of developing countries and protect the lives and livelihoods of poor and vulnerable people against the impact of disasters. Now, we heard already about the Vision 2025. Insure Resilience already has a declaration on gender, and that is really specifically to address the differential gender impacts of CDRFI, so climate and disaster risk finance and insurance solutions, in the operationalization of this vision. And to deliver on this, it's also recently established the Insure Resilience Centre of Excellence on Gender Smart solutions, and that was launched last week at COP26 in Glasgow. Basically, this is an online repository of information and knowledge sharing platform. And it's basically aggregating a lot of resources that can be helpful for you as you're exploring this topic, and to address this gender specific and the intersectional needs that people have in terms of understanding the barriers that they face in accessing and using climate and disaster risk finance and insurance. So into the topic itself. So, why focus on gender to build disaster resilience of specifically the urban poor, but generally? So this focus is grounded in the evidence base on the gender differential vulnerabilities, risks and impacts of climate change, and also climate-induced disasters, such as, for instance, the higher mortality rates amongst women that we've heard about already. Now, this evidence base on these gender differential vulnerabilities, risks and impacts is recognised by the Intergovernmental Panel on Climate Change reports, and also the UNFCCC in its updated Gender Action Plan and its technical paper. So if you haven't read either of those, I refer you to those documents because they provide further information on this. So some particular risks and impacts related to climate disasters are based on biological factors that related, for instance, to maternity and the fact that women's childbearing role. But many of them are actually driven by both supply and demand side factors, which sort of relate to cross-cutting social norms. And these social norms influence things such as women's participation patterns as employees, as entrepreneurs, their asset base, or rather their lack of it, and also their level of formal financial inclusion as well, and unpaid caring responsibilities. And all of that really changes the profile for them in terms of the risks that they face from disasters, but it also has real implications on the supply side in terms of the actual climate and disaster risk finance and insurance approaches, whether those are provided by microfinance institutions or others. And these solutions really need to acknowledge that these risks can vary by an individual's gender. And for instance, the insurance products that are being designed to reach women, whether these are microinsurance products, for instance, need to consider the distribution channels, because, for instance, there is that lower level of access to finance that many women are facing. So just in terms of the actual disaster risk financing instruments, we've heard already from Jerry that the various different instruments that exist, and the case for integrating gender considerations in disaster risk financing really starts from this assumption that women and men can be differentially impacted by and also engaged in these different financing instruments and models of climate risk insurance. And these instruments can and have the potential to really acknowledge that there are these gender differential vulnerabilities to climate change between different groups of women and men. And these instruments themselves can also influence the dynamics of these behaviours and norms and relationships between people. So one thing I do want to add, we do often talk about this in terms of a focus on women. However, it's not, when you're looking at gender, it's not about an exclusive focus on women. Gender considerations are not meant to exclude men, but quite often you end up focusing on women because of some of the historic gender inequalities that have existed, and that's why quite often there are these very deliberate strategies there. And the other point that I think is really important to remember is acknowledging that women and men are not homogenous groups, and there are different other factors that intersect with their gender, such as their ethnicity. And what we're talking about today actually is around geography as well. And that changes the risks that individuals face. So today's the focus on the urban poor, and there'll be factors related to this sort of geographical segment of women that may differ from rural poor women that need to be accounted for in the design of these products. So then just turning very specifically to the gender impacts of disaster microfinance solutions. So on the supply side, there are these different models of climate risk insurance, and women and men can play different roles within the value chains of these models. And disaster microfinance solutions are as a micro level risk financing solutions. But yeah, all models can be influenced by social norms, and considerations need to therefore be considered in terms of both for microfinance solutions, but also these other different models of climate and disaster risk finance in terms of the product features, the marketing and sales distribution model, how you choose to staff and service your clients, who's investing in them as well, and the client profile themselves, because there are these gender components there that are relevant for all of these different aspects of the solution. So through our research at Insure Resilience, we've identified examples of gender approaches that have been implemented in different models of climate risk insurance, and where there are gaps and practices and potential gender entry points, including at the micro level and specifically within microfinance solutions. And it's really highlighted through this work that distribution channels that aggregate large groups of women, such as microfinance institutions, can really be powerful entry points to scale up risk protection for women who are vulnerable to these impacts. And at the micro level, there's really an opportunity as well to raise awareness of the business case for developing women-specific or micro-level climate risk insurance is bundled with existing women-targeted financial products through microfinance institutions. And what we've identified is that there are some existing practices related to this that focus on mainly actually the rural poor as opposed to urban poor women. We've also identified that there are some gaps in practices, and these provide really a framework, both theoretical but also practical, in terms of how to design gender smart disaster microfinance solutions. So in terms of what our research has identified and how to go about this, drawing from existing good practices internationally and also what we understanding generally as well. Firstly, it's around identifying through market research gender diverse risks and insurance needs to inform the product design and pricing strategy. Also, there is a real need to account for gender differences and preferences for bundled products, and to take into account the payouts aspects, particularly with that. There's importance to leverage marketing and distribution channels that are accessible to women. For instance, we know that there's a gender gap in mobile phone ownership, and so that can be a factor that needs to be considered within the design and of the products, but also in how you choose to be distributing them as well. There is an issue around capability training, the need to increase knowledge and understanding of climate and disaster risks in general, and the opportunities that disaster risk financing solutions can provide to cover some of those risks for women. And these trainings need to also account for differences in financial competence between women and men. Now that changes from country to country and place to place and within communities as well, but accounting for that is a key aspect that needs to be considered, and we've seen some existing practice on. There's also really an opportunity to think about the whole business model when you're delivering microfinance, and just in the same way as people have been starting to think much more about the entire model of just delivering microcredit, for instance, to women, and looking at the leadership and the workforce of microfinance institutions to ensure that that is gender diverse to support the servicing and distribution of products to women clients. And then finally, and this is always a little bit of a tricky one, because if you've got an organisation that is focused mainly on women, sex disaggregated data is in your client portfolio is a little bit more skewed towards women anyway, because they're mainly your clients. But yeah, looking at in terms of gathering sex disaggregated data in payouts of climate risk insurance solutions from disaster microfinance, and seeing in terms of the direct beneficiaries who's actually benefited from that payout and how, and looking at the differences within a household between men and women as well, even if it is the woman that is receiving the payout. So these are some of the examples of practices that we've identified to consider when you're designing gender smart disaster microfinance solutions. I just want to highlight before I end that Mahila Housing Sewa Trust, so Mahila Housing Trust is one of our gender working group members at Insure Resilience, and they work with women from urban slum communities in the South Asia region, and they've really been starting to focus on building women's climate resilience and have been starting to look and establish climate risk insurance for urban poor women, thinking about very much the very specific risks and needs that they have that need to be addressed within any insurance product. And they're working with Global Parametrics on that, and we can talk maybe more about that later. And then just to finish, just to give you some further examples of organisations within the region that are taking a gendered approach to the climate risk insurance solutions at the microfinance level. Insure Resilience has an investment fund, and it is working with a number of MFIs in the region that are focused on women and disaster risk finance. So in addition, actually, I should add to Vision Fund, which was mentioned by Jerry early on, but that we've also got Pahal and Satyam Micro Capital Limited in India, and then the Kashif Foundation in Pakistan. And I just really want to highlight, just to close, how there's really a clear opportunity for more tailored disaster microfinance products that really are taking an intentional focus on the needs of women in the conceptualization and piloting, and then specifically also looking at the urban poor women, because that's where we're seeing a gap at the moment through our research. And if we're really to build resilience of urban poor women specifically, we will need to be tailoring the solutions to their needs and thinking about it in a holistic way throughout microfinance business models. And it's only through doing that will we be able to achieve Insure Resilience Vision 2025 and through actually really addressing the gender dimensions of climate risks and insurance needs. And really we welcome at Insure Resilience the opportunity to work with you all to support closing this gap in the market as well. So thank you.
Thanks so much, Catherine. I think you made some really great points there. And one of them that I thought was interesting, for instance, the gendered considerations are not meant to exclude men. And so one of the things that's important in the design of these solutions is how do we design solutions that are able to reach scale? And scale is important to be able to make sure that the costs of issuing the product can be minimized, and I guess the impact as well. And you made a follow-on point that women and men are not homogenous groups, that there are other factors that you could need to take into account in the design, such as ethnicity or whatever it might be. There was one question that came in that said, as women are not homogenous, should gender-focused microfinance specifically focus on poor women and not just any women? So I guess we're thinking about a microfinance institution that perhaps serves lower income, but perhaps middle income clients as well. Should gender-focused microfinance focus specifically on poor women as a non-homogeneous group? Yeah,
I mean, I think the key thing is just to take a client-centric approach in in designing your solutions. So understanding through data collection, through research, through focus groups, what the differential needs are. It could be some of the needs are the same, some of the risks are the same, in which case, there isn't necessarily any particular tailoring that is needed. But quite often you do see very distinct profiles and that need to be accounted for in the design and servicing of these different groups, whether they're your urban poor women or middle income urban based women, and that could relate to paying capacity. It could, which Jerry I think mentioned as well. There are going to be different solutions for different groups of women, depending on the level of financial competence they have, financial resilience they have, the asset base as well. And so that all needs to be accounted for. I want to just give you one reflection, which actually I think the pandemic has taught us, is that if you're a poor woman and your children are no longer able to go to school because of the closures, because of COVID, everything shut down, and you're now having to look after your children. You may be in a situation where you're not able to be undertaking some of the entrepreneurship activity that you need to make a living. And so even if credit is extended to this group at a time of a disaster, they may not be able to take that up if they have got the caring responsibilities of the children. So it's amazing that an MFI might provide that solution and that opportunity at the time of disaster. But you'll find, because of social norms, that group of women are probably very busy looking after children and haven't actually got time to continue to pursue that entrepreneurial activity. And their household takes a hit. They might be relying on their partner to have that earning. What you might see, and which was interesting from some research I've separately done in Bangladesh, is that actually, the slightly middle income women may still be able to afford to pay someone to look after their children, so they can continue their entrepreneurship activity directly after a disaster to help rebuild their livelihoods and lives. And so those sorts of dynamics are things that we really need to start thinking about from a behavioural perspective. And that's why approaches such as human-centric design is so important to understanding what these needs are, tailoring them, and then being able to respond as MFI, or even other forms of financial institutions to be able to provide the support that these women need from these different segments.
Thank you. That's a great example. I had one other question here that I'll try and answer. So MFIs are important for the urban poor since the former provide jobs or income to the latter. Thus, they need to be supported, such as through rebuilding of the balance sheet. It's important to provide support to MFIs even before a disaster strikes. Excuse me. But this will depend on the robustness of weather forecast data. What are other challenges for operationalizing this, particularly in the urban context? So without diving too far into the whole world of forecast-based financing, I think you're very right. There are a lot of challenges in trying to operationalize that, in terms of having the finance online based on solid forecasts is one challenge, but there's really challenges in trying to get that financing into the hands of people that most need it before a disaster strikes. And so one thing that I wanted to point out here with this particular question is that when we're talking about these ex-ante risk financing, although sometimes, or although in all instances of, for instance, insurance based on the event occurring, the payout does come after the disaster, but can be designed in a way that that payout is paid out very quickly after an event. And an example of that is using parametric insurance, where the insurance is based on the readings, for instance, of rainfall or category of storm, whatever it might be, specific parameters that when reached provide a certain level of finance to, for instance, a microfinance institution or an individual. And so when it's designed in that way, the payout is not delayed by the need to inspect losses. It can be simply a weather reading that's measured. The payout is then made. it can be lower cost that way because of the lack of need for investigating the losses. And so even though this is paid after the event, it's structured ex ante, it's put into place ex ante before the event happens and can pay out very quickly as well. And these types of solutions can complement each other as well. In terms of forecast-based financing, I think there's a couple of examples based on floods in Bangladesh that could be interesting to look into.
So maybe on that, one thing to really take into account from a gender perspective is, even if, for instance, the woman is the one that is supposed to be receiving that payout, whether she actually does receive that and she is the one that uses that payout to build resilience or rebuild after a disaster. Because what we've seen from elsewhere in the world is that, for instance, if it's paid out to a mobile phone, actually, even if the policyholder is the woman, she may have used her husband's mobile phone number, so he receives the payout and then uses it, and it may not be used for the intended purpose. So there are dynamics there, and that's why it's so important to be gathering the data afterwards to understand, did they receive the payout that they were entitled to, and how was that used, but also interviewing more than just the recipient and understanding the wider gender dynamics of how that payout might be. But on your point around some of the data and the risk information for informing these payouts, what we realize at the moment is a lot of these catastrophe risk models and parametric models, because they're focused on the hazard, they're not necessarily accounting for differences in vulnerability at the moment. And that's where we need greater data, and for MFIs and others, stakeholders that are sort of in this space, to be calling for more nuanced data built into models where it's feasible. Obviously on the hazard side it's not possible, but on the vulnerability side it is. And that there can be data that's drawn from existing data sets related to financial inclusion, for instance, or other data sets that will show those nuanced differences between urban women and urban men, and the impacts and risks that they face as a result of a particular impact. Migration data sets, for instance, that is sex disaggregated. And so we often come to this, it's not a perfect solution, but quite often data isn't being sex disaggregated that is informing these models, but it could be. And if that data is collected in that way, we will be able to design better products that will then better address these differences in resilience building sort of measures that are needed, and the risks faced by different groups of people, regardless whether they're male or female, and the different groups sort of within that as well.
3 minutes left.
So
Sorry, go on.
Good. No, one point I wanted to just highlight, in fact, I mentioned Mahila Housing Trust, and one piece of work that we're going to be doing with them is looking at poverty-related barriers to access to climate and disaster risk finance. So that's something Insure Resilience and Mahila Housing Trust are going to be working on to understand, these gender differences there as well.
That was actually going to be my last question, whether there are any points, very briefly, say 1 or 2 minutes of this work with the Mahila Housing Trust. Was there anything you wanted to highlight from that example?
Yeah, really just to say that they're starting this process now of developing this climate risk insurance for the urban poor, and their focus is on women. In fact, they've just won an award at COP for their work on resilience building specifically with women and urban women, and they work on microfinance as well. So it's sort of part of what they see as one of the resilience building strategies that is needed. And I think what's really interesting from their approach is they're seeing that the urban location is actually what is determining determining the form of poverty and the risk that these women are facing, and they want to take that into account in developing this product and these resilience building measures. So they're working with Global Parametrics in developing this index-based insurance product. It's going to cover flooding and heat waves and risks in Ahmedabad, Vadodara and Surat and Gujarat in Western India. And so, yeah, I think really it's a matter of watching this space. What they have done already, and I think it's important to note how important this is as well, is working on the demand side and understanding what behaviour change is needed, and understanding from the client side around, how they interpret climate risks and the causes for that, and what they've been doing very specifically is talking science to women and understanding sort of the reasons for this and how this type of solution will be able to support with their resilience building efforts. So as I say, watch that space. There'll be information put on the in the Insure Resilience Centre of Excellence for Gender Smart Solutions, so you can find more information there. And then, as I said before, that there is this gap in research on this urban women, urban gender sort of intersection of climate risk insurance and microfinance. And so, if any of you on this call in the session clinic today, have ideas for research, approach Insure Resilience. Research is going to be a key part of the work it's doing going forward. Along with some technical advisory and having experts as well available to draw on for you through an expert directory to access some of this guidance. But do come to us with your ideas for research that you think is needed on this area to better understand the risks that these urban poor women are facing, and how disaster financing solutions at the microfinance level are going to be able to support that. So thank you.
Thanks, Catherine. Well, we're at the top of the hour now, so maybe just a couple of housekeeping notes to close. So please submit a quick evaluation of the session through the feedback tab on the right-hand side of the screen. And those requiring a certificate of attendance may request one by clicking on the tab on the left side of the screen. To close, I really only wanted to say a few thank yous. So firstly, thanks to the organisers for their help to put everything together. Thanks to the participants for being here. I hope it was an enlightening session. I definitely enjoyed it a lot. But a big thank you to Catherine and also to Jerry for their presentations. And Catherine, thanks for joining us live as well. Really appreciate the time that you took. So thanks everyone. Thanks for joining us.